Hey everyone, it's Scott here, and in today's video, I'm going to share with you how you can pay zero income tax when you invest in property the right way. I'm also going to share with you the concept of negative gearing. There's a lot of noise and a lot of misinformation out there about negative gearing. Is it a good thing? Is it a bad thing? How does it even work? What even is it? I'm going to unpack all of that as well. So before I get into it, because I'm going to be talking about things like wealth and financial creation and also tax deductions and how tax works, I've got to give you this disclaimer. So all of the information today is just my opinion. It is not financial advice. It is not tax advice. And it's mostly for educational purposes. Now, a lot of the information that I go over, it's not final and complete. So I'm not going over a real situation. I'm going to be using numbers to illustrate the principle of how this works. So before I get into it, just an interesting bit of information. Did you know that there are a number of millionaires that declare multi-million-dollar incomes to the tax office, but they do not pay any tax? In fact, according to the ATO, in 2021-2022 financial year, there were 102 people, millionaires that earned $1 million or more, that did not pay 1 single cent of income tax. And some of the secrets that I'm going to cover in this video will show you how they are able to do this. Now, what you may also like to know is that high income earners, typically, they are the ones that are utilizing something called negative gearing. Now, negative gearing allows you to claim thousands of dollars of your own tax money back from the ATO. And you can collect that monthly, or you can collect it at the end of the year in a lump sum that will get refunded back to you. And I'm going to share with you how this works. But you can see here that on this particular chart, up this end, you've got incomes. So you've got people up here to a $400,000 a year income. And across here, you have the percentage of these people who use negative gearing. And you can see here in orange, these are the highest people. These are the people that have the highest incomes. And you can see here that over a quarter of them, up to a third of them, are actually utilizing negative gearing and the tax deductions you get from negative gearing to reduce the amount of tax that they pay. In many cases, they can reduce the tax that they pay to zero. Now, it's important to note as I start teaching you this, that you're going to need more than one investment property to reduce your tax to zero. But I want to share some stats with you about the number of landlords in Australia. So you can see here that there are actually 2.3 million property investors or landlords in Australia. 71.5% of them have one property only. Only 19% have two or more, and only 6% have three or more investment properties. So very few Australians get to three investment properties or more. Now, I deal with thousands of investors every single year, and the majority of my members and my clients are actually getting to multiple properties. So there are some secrets and some inside tips that you need to know to be able to get to multiple properties, okay? But what I want to lay out for you is that if you do want to pay zero income tax, you're going to have the strategies to get 3, 4, 5 or more investment properties. Now, I just want to share with you briefly the incomes of Australians and what they pay in tax. Now, you can see here on this chart that an Aussie making $150,000 a year is going to be paying $36,000 in tax. That's a huge amount. And you can see here an Aussie that makes $200,000 a year is going to be paying $56,000 in tax. And you can work incredibly hard. So you can see here that you can work additional hours, you can put more in, you can study more, work harder, do all of that and increase your income from 200K to 300K. And the government will dip their hands in and grab another 50K off you, and you will wind up actually paying $100,000 in tax. So it can seem like the longer you study, the harder you study, the longer you work, the more hours you put in, the more that you sacrifice to earn income, the more the government just takes this money off you. And that's why tax reduction strategies are incredibly important. Don't get me wrong. I believe that we should pay tax. I believe in free healthcare, education, all of those great services that we have here in this incredible country. I believe that we should pay our fair share, but it's absolutely ridiculous that the hardest working people, the people that sacrifice the most, literally have to carry the majority of the tax burden. Now, this is where we're going to actually take a look once and for all at negative gearing and how it works and how the tax deductions actually work. Now, to set this up, you've got to understand how the Australian tax system works for income tax. Of course, we have GST and other taxes stamp duties, land taxes, all of these things. It just seems like there's a never-ending list of taxes that we have to pay. But the main tax that we all pay is going to be income tax. So you can see here that in Australia that it's a sliding scale. So as you move up the income amounts, you're going to pay more tax. Now, if you earn an amount of 18,200 or below, you're actually going to pay zero income tax. Now, for the amount of money that you earn above 18,000 up to 45,000, on that chunk of your income from 18,000 to 45,000, you're going to pay 16% tax. Now, what I have to say is that for most Australians, you've got to add on top of this the Medicare levy, which is an additional 2%. So in fact, it won't be 16% for 99% of Australians. It's actually going to be 18%. So to all of these amounts here, add 2% for the Medicare levy. Now, for every dollar that you earn above $45,000 up to $135,000, okay, this chunk of money here, you're going to pay 30% tax only on that amount between those two amounts, okay? So 30% plus the 2% Medicare levy, that's 32% overall. Now, for every dollar you earn over 135,000 up to 190,000, it's 37 plus 2%, 39%. And for every dollar that you earn over 190,000, you're going to be paying 47% tax, 45 plus the 2% Medicare levy. So the more you earn, the more tax that you pay. Now let's just take a look at this example, okay, of someone that earns $150,000 salary. But what we will look at is $150,000 salary. Now, an Aussie on $150,000 salary is going to pay $36,800 of tax. That is a huge amount of tax that they're going to pay. And if you do the math on the different chunks here, you'll see that it will work out to be $36,800. Now, how do I then use an investment property to reduce that amount of tax that I pay, that $36,000? How do I reduce it by getting an investment property? So I'm going to teach you exactly how this works now. So with an investment property, we're going to use an example of a $700,000 property. And I'm going to use an example of about a 5% rental yield, which means you're going to collect about $729 per week of rent on this property. Now, this is actually $35,000 in rent for the whole year. I'm also going to assume that you've paid a 10% deposit on this property and you've got a loan amount of $630,000 against the property, a mortgage against the property of $630K, and you're going to be paying 6% interest on that loan, okay? That will be very important for the calculations that I'm about to show you. So you can see here that I've got an additional $35,000 of income that gets added to and stacked on top of my salary. So $35,000 of rent here that you can see, stacked on top of my salary there. And you can see here that this $35,000 of additional income is sitting within the $135,000 to $190,000 bracket. Any dollar earned within this bracket, you've got to pay 37% tax plus 2% Medicare, 39%. And so every dollar earned here must have a taxable amount against it of 39%. So 39% of that income is going to be taken from you by the government. Now, there are also, however, some deductions that you get with owning the investment property. And this is where things get extremely interesting, because some expenses on the property are tax deductions, which reduce the amount of your income. So you can see here that your total income is the 150K plus the 35K. Total income is 185,000. And the tax, if you do the calculations along here, is about $49,788. Now, let's take a look at those deductions. So the first deduction is the interest on your loan. So a $630,000 mortgage at 6% annual interest, the annual interest for year one on that property is $37,800. Now you've also got some other expenses like council rates, land rates, rental management. You've also got things in here like insurance. And altogether, these are what are called cash expenses. This is very important because there's a distinction between cash expenses and non-cash expenses, which I'm going to explain to you in just a little while. So the total of all of those cash expenses are also added to the non-cash expenses. Now you're going to see here that there's an expense here called depreciation. This is very important, and I'm going to explain it all to you. Now the total of all of these expenses is $61,100. Now this is the interesting thing here, because these cash expenses are actual expenses that you've got to reach into your wallet, take the money out of your wallet, out of your bank account, and you've actually got to pay these bills in cash. So loan interest, you've got to pay that to the bank. Rates, that's the council. Rental management, that's your property manager. Insurance, that goes to the insurance company. So these are real bills that you get that you've got to pay. Now you're using the rent here and also your other income here to cover those bills, and they are deductible. So all of that money there, all of those expenses there, you will not pay tax on. It's going to reduce your taxable income. Now, in addition to that, you've got depreciation. Now, what is depreciation? Because it's a non-cash expense, or this is like a rebate that the government gives you for free. So the government says, because you're investing in property and because you're taking your retirement into your own hands, you're going to hold an asset to produce an income for the future so that potentially we don't need to pay you a pension. We're going to reward you for doing that. And the way we reward you for doing that is to treat this as an investment and to actually give you the deduction of depreciation. Now, depreciation is simply the cost of what it took to build this property, all of the materials, all of the labor and all of that, the tiles, the roofing, the flooring, you've got your kitchen fixtures and fittings, you've got your bathroom tiles, all of those have a cost to them. And what they actually do is they say all of that cost can be offset and depreciated, not all together in one hit, because it might cost $300,000 or $400,000 to build the whole home. But what they'll do is they'll get that total amount of what it costs to build the home, $300,000 or $400,000. And you can see here in this example, the total house is $700,000, so maybe the land is $300,000, and maybe the build on the house is $400,000. So that build component and everything in the build can be depreciated over the number of years that the asset is likely to be functional. So the tax office takes it that a house will last about 40 years before it needs major structural renovations. And so they allow you to depreciate that house over 40 years. You might have things like carpet, where the tax office will say, hey, that's got a life of 7 years. They'll allow you to depreciate the cost of that carpet over 7 years. And so when you do all the calculations on that, you wind up with a depreciable amount year by year by year, typically over 40 years of the property. However, because most of the items only have a usable life of 5 years or 10 years, most of the depreciation is in year 1. Year 2, the depreciation gets lower. Year 3, it gets lower again. And so depreciation is at its best and at its highest in the first 10 years of owning a property. And this is key. Depreciation, you only get it at its maximum rate when you've got a brand new property, okay? So this really only works to its fullest extent when you invest or when you build and construct a brand new property for investment purposes. Now, on this particular property, the depreciation is likely to be something like $17,500 in the first year. Now, it's a non-cash expense, so you haven't had to actually fork money out that year of the amount of $17,500. It's the depreciation from the overall value of this property. Now, when I add up all of these expenses, cash expenses and non-cash expenses, I get $61,100. Now, this amount then is a deduction off of your taxable income of $185,000. Now, when I take $185,000 and deduct $61,100 of cash and non-cash expenses, I get a new taxable income of $123,900. So your taxable income now is a lot less. Now, let's just take a look at this for a moment, because you had a salary of $150,000 and your HR department at your company, what they would have been doing is every month you'll receive your salary. Maybe it's every fortnight or every week, but let's say you're receiving that salary every single month. They're not going to give you the whole $150,000. They're going to withhold some money to pay to the tax office. And in Australia, by law, your employer needs to hold that money back and pay it direct to the ATO. They don't trust you to touch that money. They know that you'll spend it. And so what they do is they get it paid to them direct from your employer before you even get to touch it. It never even hits your bank account. And so They would basically take that $36,800 of tax, which is due for you for the year. They'll divide that by 12 months in the year, and they'll hold back that relevant amount of tax. So during that year, you would have paid $36,800 of tax on the $150,000 of salary. Your employer won't hold any more back than that because they're not aware, and nor are they responsible to collect tax on the $35,000 of rental income. So you now will declare to the tax office that you have a taxable income of $123,900, and tax on $123,900 is actually only $27,958. So let's recap here. You've actually been paid a salary of $150,000, and on that salary, you've paid $36,000 of tax. You've got an investment property and you've added $35,000 of rental income, but you've also got cash expenses, which are deductions, and you've got non-cash expenses, which are deductions. Your total deductions are $61,100. Now, when you work out the tax on the new taxable income of $123,900, your tax now is only $27,958. You have in fact paid $36,838 in tax, meaning you are legally due for a tax refund of $8,880. And this is how you are able to use an investment property to get a massive tax refund. Now, if you repeat this over 3, 4, 5 properties, there is the potential for you to reduce your income tax to zero. And many people do it, and some of our clients even do it. If you can't get it to zero, well, maybe you can pay 50% less tax, 60% less tax. But paying less tax is a good thing, especially when that tax money is used to hold an asset which over the last 100 years has been growing at a capital growth rate of 7%, which is residential property. And you've only needed a 10% deposit to own that particular property. So where does the negative gearing come in? Well, this is negative gearing. Negative gearing, simply what it means is this. You've collected $35,000 of rent on the property. That's the income. However, you've got expenses of $61,100. So the fact that the expenses are much higher than the income, it means you are negatively geared because the cash flow on that property prior to the tax refund is negative. And because it's negative, you can claim a massive tax refund. Now, you will note that if I add this tax refund back into the pool of money that I've got from the year, basically holding this investment property is neutral for me. It doesn't actually really cost me any money to hold it. The reason for that is, even though I'm negative on this particular property, once I add the tax refund back in, it works out to be a neutral hold. You're neutral on the cash flow, and then you can enjoy that 7% capital growth on this particular property. And then the idea is hold this property for 10 years, 15 years, 20 years, sell it at some time in the future, and create a nest egg for you and your family so that you can retire early. So I hope you have enjoyed this video. I hope this once and for all explains negative gearing. Negative gearing is not a bad thing. It is not a good thing. It simply is a mathematical calculation which exists based upon Australian taxation law when you invest into property where the overall expenses on your property are more than the income on your property. But you will notice that the reason why the expenses are so much more than the income, the main reason being because of depreciation. And you must realize that depreciation is a non-cash expense. Also, one of the key lessons, this is only available to its maximum extent on a brand new property. And this is why I focus on brand new properties. And this is why I encourage the over 10,000 member and clients that I've served over the last 5 years to focus on brand new property. Can you create wealth with other types of property? Yes, you can. But can you also create wealth with brand new property? Yes, you can. And what is the added advantage of doing it? You're going to get these negative gearing benefits. You're going to be able to access all of this cash through the tax system to help you to grow your wealth. If you want to actually speak to one of my team to actually get a detailed analysis for you with your own numbers, I've got a link in the description below for you to be able to make contact with the team. Take care, everyone, and thanks for your time.